Finance Minister Chrystia Freeland there commenting on the Bank of Canada's decision to hold its key interest rate at 5%. The federal finance minister doesn't usually comment on rate decisions, but her remarks do follow a call from three of the country's premiers for the bank's governor to stop raising rates. Today, the bank warned, though, that may not be possible, that it's still worried about inflation and remains willing to hike rates again if needed. Let's bring in some of this country's top economists to unpack all of that. Avery Schenfeld is Managing Director and Chief Economist of CIBC Capital Markets. Jimmy Jean is Vice President, Chief Economist and Strategist for the Desjardins Group. And Jean-François Perrault is Senior Vice President and Chief Economist at Scotiabank. Hello to all three of you. A real pleasure to welcome you to the program. I appreciate you making the time. Mr. Schenfeld, I wanted to start with you. In layman's terms, from where you sit, why did the bank hold the line on today's decision?
I think the bank did so because interest rate hikes that they've already delivered seem to be working now. So the Bank of Canada was skeptical earlier in the year that the level of interest rates that they'd achieved would in fact slow the economy down enough to take care of the inflation problem that we still have. But if we look over the last few months, we've seen the unemployment rate move up 0.5%. We've seen economic growth stall, albeit hit by fires and other disruptions, but it does look like a slowdown is in place. And while that hasn't fully taken care of inflation, if it continues and the economy continues to remain sluggish, we do expect that both wages and prices will decelerate. So they're getting enough of the bad news on the economy to put away the rate hike weapon.
Mr. Jean, how bad might the bad news get? And by that, I mean, if we're just beginning to see the effects of rate hikes that started 18 months ago, how pronounced might that impact be, let's say, 6 months from now?
Well, and I think that also plays into the decision today, because as you mentioned, it's been 18 months since the very first rate hike. And what that means is that we're now entering the period of maximal effect of those rate hikes, which is typically between the 18th and 24th month mark. So, you look at the renewal cycle, by the end of next year, you'll have 66% of mortgage holders who will have renewed at higher interest rates. So that means there's more pain ahead, definitely so. And as Mr. Schenfeld just mentioned, we are already seeing some weakness, not just in terms of growth. I mean, 2 quarters of contraction in the last 3 quarters, but also in terms of employment. You look at weekly jobless claims data, and it's shooting higher. And also, you're starting to see some cracks in the very interest rate sensitive sectors like construction, where we see hours work and jobs fall. I think that will only continue. So with all that in mind, and with core inflation decelerating, I think the Bank of Canada has enough justification, even if verbally it maintains that threat. But, effectively, I don't think it will execute on that. I think the next move will be a cut.
Mr. Perrault, what is your sense about the possibility of future hikes, and what will you be watching to kind of inform your view on that?
Well, listen, and I think you got some of this in the Bank of Canada's communique today. It's basically a horse race between the speed at which the economy is going to slow and the speed at which those kind of inflationary pressures are going to abate versus the speed at which inflation actually moves. So as Avery indicated, we've had a slowdown in economic activity. Inflation, on the other hand, core measures of inflation, as the Bank of Canada pointed to today, are kind of stubbornly in the 3.5% to 4% range. And we're going to need to see some compelling evidence going forward, or the Bank of Canada will, that inflation is breaking out of that zone and heading lower, which we're confident will be the case, but they still need to see evidence of that before they're willing to call it either on the cutting side or on the increasing side.
Mr. Schenfeld, the idea of the stubbornness or stickiness of inflation, can you help Canadians understand? I mean, I think it's something very tangible to all of us, right? We know that prices remain high in so many of the different areas in which we're making purchases, for example, or just doing our day-to-day life. What is it about inflation right now that keeps it as stubborn as it has been?
Well, it's certainly a global story here. For all the politicking in Canada, we have to remember that Europe, the U.S. all saw a big run-up of inflation. And relative to some countries, actually, Canada's done a little bit better than some in getting inflation down to earth a bit. But what sustains inflation at this point now is more actually the purchasing power that Canadians have. The Bank of Canada mentioned that wages are growing at 4 to 5% a year for the typical worker. That gives people spending power to pay the rent that is going up, but also maybe drive some other prices higher. So ultimately, we need to cool wages and prices together. And what's going to do that, in our view, is the fact that the labor market is starting to loosen up. So not only has the unemployment rate moved up, but there are fewer job vacancies now out there. And we suspect that that 4 to 5% wage gain will decelerate to something like 3% by this time next year. And when people don't have the spending power, that's when ultimately sales have to happen somewhere in the economy to keep us buying the goods that are on the shelf.
I have a few questions about the labor market, but I just really quickly want to follow up with you on one point, Mr. Schenfeld. You mentioned the politicking. Our audience will be very, very familiar with the back and forth about the role fiscal policy has or does play in inflation. And I wondered, from your assessment in the Canadian context, what role it currently is playing.
So it played some role, certainly, in driving the economy to full employment and maybe a bit through full employment. We saw the same thing in the U.S. The Minister of Finance actually hinted at this a bit. She said, well, she's going to do, in conjunction with the provinces and other levels of government, everything she can to facilitate interest rates eventually coming down. Well, what is that? Well, within her purview is fiscal policy. So if governments actually spent a little bit less, didn't hand out as many checks to help people, quote, cope with inflation, there'd be a little less spending power in the economy. So maybe that's a message that the federal government, and hopefully joined by the provinces, because they were a big part of this too, handing out all those checks to Canadians in the last year or so. If they pull back a bit from that, that will actually ease up on spending power and perhaps give us an earlier date at which we could actually enjoy somewhat lower interest rates.
Mr. Perot, do you share that assessment? And when we talk about pulling back on spending, can you help quantify that? Would it have to be a big pullback, or just to use the same term, a holding of the line?
Well, there's no question that this is the case, right? That fiscal policy, for all intents and purposes, over the last year and a half, has run a little bit across purposes what the Bank of Canada has been trying to achieve. Remember, we've been raising interest rates to try and slow economic activity. That entails some degree of harm. You're trying to, reduce people's purchasing power. Governments, on the other hand, have been out there, as we indicated, trying to provide some support to households who are hard done by on the inflation side and the interest rate side. So there's been a bit of a conflict there. So there's no question about it. And when you kind of contextualize it, we've done some analysis, you're probably looking at, 50 or 75 basis points of the increases in interest rates so far that flow from these fiscal measures that have been rolled out at various levels of governments to try and help Canadians in a bit of a perverse way in some sense. So you do need, at a very minimum, no more additional measures, which is difficult in the current environment. You see the premiers and Minister Freeland out there already talking about the damage that's being done and hoping the Bank of Canada is going to cool its jets to some extent. That's because they know that individuals are hurting, and the tendency in this environment will be for governments to keep doing what they have been doing, which is there something we can do to help offset some of the pain that people are dealing with? So at a minimum, no more of that stuff, and of course, ideally, a little bit of a pullback on some other levers. But that, you're talking about program spending, cutting things that are very difficult for governments to cut at this point.
Mr. Jean, my final question to you, kind of circling back to the labor point, or the labor market problem point that Mr. Schenfeld made, and I just felt like there are probably a lot of people watching who keep hearing that the success of the Bank of Canada's measures kind of will lead to a loosening, right, of the labor market and a slowdown of the economy, and they might be worried about their own job prospects. And I just wanted to know, from your perspective, what your thoughts are on the prospect of a recession or the prospect of pronounced job losses, or whether that soft landing we've heard so much about is still possible.
Right. Well, and you've seen evidence in the U.S. that suggests that they're able to get their job vacancy rate lower without causing that much of an increase in the unemployment rate. So it's something we haven't really seen historically. When job vacancies start to go down, usually unemployment rate goes up. But now it seems like they're in a spot that is encouraging. Now in Canada, it's a different situation because we have so much population expansion. So what that means is that when you start to see employers with less appetite to hire, well, that causes the unemployment rate to go up quite rapidly because the labor force keeps expanding. And that's what we've seen in the last few months of data. So the question will be when, the more that goes on, whether we're going to see less arrivals of non-permanent residents, temporary workers in particular. It might take a lag before we start to see that. So the risk of seeing the unemployment rate go, at least initially, higher very rapidly, I think it's an appreciable risk. And it speaks as well to a situation where employers have been relying on foreign workers as opposed to investing more in automation and things that could enhance productivity. Now that you're in a situation where you're seeing less demand, the easy fix is just to lay off people. But more structurally, more long term, it would have been preferable to have Canadian companies invest much more, like they're doing right now in the U.S., because ultimately productivity is the antidote to inflation. So that there's that part not to forget as well. We're talking about strong wage growth and that fuels inflation, but the investment is actually what does the opposite.
Okay, I have to leave it at that point. I very much appreciate the discussion and the analysis from all three of you. Thank you, Avery Schenfeld, Jean-François Perrault, and Jimmy Jean.